The Property Bulletin by London Property, the home of superprime.
The London prime property market navigated a nuanced landscape in 2023, marked by delicate consumer confidence and a notable divergence between sellers' and buyers' perceptions. This dissonance has been a key obstacle to reaching agreements throughout the year, resulting in a 25% decline in transaction volumes compared to the previous year. Despite this, transactions driven by international buyers seeking prestigious properties or conventional catalysts like debt, divorce and death have persisted. Notably, sellers resistant to perceived low offers have demonstrated resilience, particularly in securing strong prices for top-tier properties. However, properties requiring renovation or updates have lingered on the market, and less priced to reflect the additional costs and complexities involved. Renovation projects have become notably more expensive, with quotations often exceeding expectations. Now in 2024, there is a sense of cautious optimism within the industry. While the prolonged stagnation in the prime central London market raises concerns, there is anticipation for potential growth amid factors such as improving average incomes and potential adjustments in the Bank of England base rate. Nonetheless, the forecast for transaction volumes remains tempered, with many property owners opting to await more favourable conditions before selling. The resolution of global conflicts and political stability domestically could contribute to a more active market in the latter half of the year. Despite this cautious optimism, the market continues to face uncertainties, including ongoing financial and geopolitical challenges. Over the rest of this year, navigating these complexities requires a nuanced understanding of economic dynamics and market sentiment, shaping the appetite for prime UK property investments in 2024. A recent report from the Social Market Foundation, SMF, a left-wing London-based think tank, suggests that landlords could withstand much stricter regulation in the private rental sector without significantly reducing rental property supply. The SMF argues that compared to similar countries such as Scotland and Ireland, where longer tenancies and stricter regulations exist, England's rental contracts tend to be relatively short, and no-fault evictions are common. Despite fears that tougher regulations might deter landlords, the SMF claims that evidence from these countries suggests otherwise. For instance, Scotland has seen an increase in the number of households in the private rented sector since banning no-fault evictions in 2017, and Ireland has experienced a doubling in the size of its private rented sector since introducing indefinite tenancies in 2004. Though of course this may be down to many other factors other than rental legislation. The report also examines the effectiveness of rent controls, which are widespread across Europe. While rent controls generally reduce costs for tenants already in housing, their impact on property availability varies. For example, Berlin and San Francisco, where rent freezes and caps exist, have faced shortages of properties. However, in Ireland, where rent pressure zones are in place, there has been no demonstrable negative effect on supply. The SMF suggests abolishing no-fault evictions, introducing rolling tenancies, and strengthening the rent dispute system to make it more accessible. Additionally, they recommend licensing and registering landlords or establishing a non-compliance register to improve accountability. Nevo Reagan of the SMF emphasises the need for longer tenancies and stronger tenant protections to alleviate pressures faced by renters. The President of the United Arab Emirates, Sheikh Mohammed bin Zayed Al Nahyan, has reportedly acquired a £65 million mansion in prime central London, further expanding the Al Nahyan mega portfolio in the capital. The luxurious property, situated on the site of the former BT Earls Court telephone exchange, was purchased by a company associated with the UAE president. This acquisition adds to London's list of ultra-premium real estate transactions, with the city witnessing 52 homes sold above the $10 million mark in the fourth quarter of 2023. The Sheikh's new residence is part of a development featuring 3 identical mansions built between 2004 and 2006, with one villa previously fetching £51 million in 2015. Sheikh Mohammed bin Zayed Al Nahyan's investment underscores the continued interest of Abu Dhabi's ruling family in London's high-end property market, further solidifying their significant presence in the city's real estate landscape. Down valuations are causing significant challenges for sellers across Britain, with new research indicating that Welsh sellers are particularly impacted, facing an average reduction of £8,149 in their home's value. The analysis by Open Property Group highlights the prevalence of down valuations, where a property is valued lower by a surveyor than the agreed sale price, leading to complications for both buyers and sellers. This trend is exacerbated by an unsettled property market, higher mortgage rates, and cooling house prices. A down valuation occurs when a property is appraised for less than the agreed price between the buyer and seller, often due to discrepancies between the estate agent's valuation and the surveyor's assessment, or as a precautionary measure by lenders in uncertain market conditions. Sellers facing down valuations are left with few options, including agreeing to a price reduction, seeking a new buyer with a more accommodating lender, or addressing the surveyor's concerns, which can be costly. The analysis reveals that across Britain, the average down valuation amounts to a 2.8% reduction in property value, equivalent to £7,290 based on the current average house price. While the North East experiences the largest percentage of down valuations at 4.8%, sellers in this region face the smallest monetary reduction of £7,498. Conversely, Welsh sellers bear the brunt of down valuations, with an average reduction of £8,149, followed closely by regions like the West Midlands, South West, Scotland, and the North West. The surge in London's property market, fueled by a wave of first-time buyers, paints a promising picture for 2024. With first-time buyers accounting for over half of house sales in Q1, there's a palpable shift from renting to home ownership. However, amidst the optimism, concerns loom over the horizon. First-time buyers grappling with soaring rents and fluctuating mortgage rates are making compromises to afford home ownership, opting for smaller properties. This trade-off, while a stepping stone onto the property ladder, poses challenges for future growth and family expansion. With many first-time buyers already older and potentially facing stagnant housing circumstances, the dream of upgrading to larger homes may remain elusive. Moreover, the financial burden on first-time buyers continues to mount. Recent data reveals that first-time buyers who entered the market in January 2024 are paying significantly more than their counterparts who bought in August 2022. This trend, akin to shrinkflation seen in consumer goods, underscores a concerning reality: paying more for less space. As London's property landscape evolves, it's evident that the first-time buyer surge comes with its share of challenges. While home ownership remains a milestone achievement, the road ahead is paved with financial hurdles and compromises in space, a sobering reminder that the housing market's buoyancy may conceal underlying complexities.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.